£624 million. That is how much HMRC is holding right now in tax refunds that belong to ordinary people who never asked for them back. If you are retired and paying income tax, there is a very good chance you are paying more than you need to. Not because you are doing anything wrong, because HMRC does not go out of its way to explain the rules that work in your favor. I'm going to walk through 6 things that most pensioners get wrong about their tax. Every one of them can reduce what you owe or put money back in your account. And I will start with the one that catches the most people off guard. Most pensioners believe that because HMRC assigned their tax code, it must be correct. It is not always correct. And when it is wrong, nobody is going to phone you. In the first 3 months of this year alone, 14,000 people had to reclaim money from HMRC because they were taxed using the wrong code. The total paid back in that 1 quarter was £44 million. The average refund was over £3,100 per person. Here is how it usually happens. You access your private pension for the first time. You take a lump sum or you start drawing an income. HMRC does not know how much you plan to take over the year, so it applies what is called an emergency tax code. That code assumes you will withdraw the same amount every single month for the rest of the year. If you took out £10,000 once, the system taxes you as though you are taking out £120,000 a year. The deduction is enormous, and unless you pick up the phone or fill in a form, the overpaid tax stays with HMRC. The codes to watch for are BR, D0, and 0T. If any of those appear on your pension paperwork, check immediately. They mean HMRC is not applying your full personal allowance to that income. The most common reason is that 2 different pension providers are both being told to use the allowance, or neither is being told to use it at all. You can check your tax code through your personal tax account on gov.uk. If it is wrong, call HMRC on 0300 200 3300 and ask them to correct it. In most cases, the overpaid tax comes back within 30 days. The second thing most pensioners get wrong is marriage allowance. Most retired couples assume it is only for people who are still working. It is not. If you are married or in a civil partnership and one of you earns less than £12,570 a year, the lower earner can transfer £1,260 of their unused personal allowance to the other. That saves the higher earner £252 a year in tax. For pensioner couples, this works well. One partner has only the state pension, which at £12,547 is just below the personal allowance. The other has the state pension plus a private pension or savings interest that pushes them above it. The lower earner transfers the unused portion and the tax bill drops. Here is the part that most people miss. You can backdate the claim by 4 years. If you have never claimed marriage allowance before, you could receive up to £1,260 in a single payment for the years you missed. Apply on gov.uk or call HMRC. It takes 5 minutes and it renews automatically every year after that. The third thing is perhaps the most important, and it is the one that costs pensioners the most money. Most people assume that if HMRC overcharges them, the money comes back automatically. It does not. After the end of each tax year, HMRC checks whether you have paid too much. If you have, they send something called a P800 letter. That letter tells you how much you are owed. But the refund does not land in your account on its own. You have to log into your personal tax account or phone HMRC to claim it. If you do not respond, the money sits there, indefinitely. £624 million in unclaimed tax refunds. That is the figure HMRC has published, A significant share of that belongs to pensioners who either did not open the letter, assumed it was junk, or did not understand what it was asking them to do. If you receive a P800 letter from HMRC, do not throw it away. It is almost certainly telling you that they owe you money. Log in or call the number on the letter. That single phone call could be worth hundreds of pounds. The fourth thing surprises almost everyone I speak to. Most pensioners believe that once they stop working, they cannot put money into a pension. That is wrong. Anyone under the age of 75 can pay up to £2,880 a year into a pension, even if they have no earnings at all. HMRC automatically tops that up to £3,600. That is £720 of free money from the government every single year. You put in £2,880. Your pension provider claims the other £720 from HMRC on your behalf. Your pot grows by £3,600. This is called tax relief on pension contributions, and it applies regardless of whether you are working or retired. The only condition is that you are under 75. For a pensioner with savings sitting in a bank account earning taxable interest, moving some of that money into a pension is worth looking at. The contribution gets tax relief. The growth inside the pension is sheltered, and 25% of anything you take out later is tax-free. The fifth thing is a short one, but it matters for anyone with a spare bedroom. Most pensioners assume that renting out a room in their home means a tax return and complications. There is a relief called Rent a Room that makes the first £7,500 of income from a furnished room in your main home completely tax-free. No self-assessment needed, no declaration to HMRC required. Just keep a record of the payments, and as long as the total stays below £7,500, it is not taxable. This works whether you rent to a lodger, a student, or through a platform like Spare Room. The room must be furnished, and it must be in your main residence. The sixth and final thing is the one that matters most in the long run, and it is the one HMRC is least interested in explaining. Most pensioners assume that the gap between the state pension and the personal allowance will widen again eventually because the government will raise the threshold. It will not. Not until at least 2031. The personal allowance has been frozen at £12,570 since 2021. The government confirmed in the last budget that it will remain frozen until April 2031. That is 5 more years of no movement. Meanwhile, the state pension rises every April under the triple lock. It went up by 4.1% this year. Next April, it will rise again. The year after that, again. Each increase brings the state pension closer to the personal allowance and eventually past it. At the current rate, the full new state pension could exceed the personal allowance as soon as April 2027. That is less than a year away. When that happens, every single pensioner receiving the full state pension will owe income tax, even if they have no other income at all. No savings interest, no private pension, just the state pension alone will be enough to make you a taxpayer. This is not a prediction, it is arithmetic. The state pension goes up every year by at least 2.5% under the triple lock. The allowance does not move. The lines will cross. The time to prepare is now. Check your tax code. Claim marriage allowance if it applies to you. Make sure you are not leaving refund money sitting with HMRC. Understand how much of your income is taxable and where the thresholds are. The rules are not going to move in your favor for years. I have put everything you need below: the links, the phone numbers, the forms. If someone you know is retired and paying more tax than they should, send them this.